If you're wondering what's going on in the bond market and why are you seeing the price of your bonds decline, then you'll want to watch this video as I'll be discussing what's happening in the bond market, what you need to know about bonds, and potential moves that you need to make within your portfolio. Welcome back. This is episode 320. This week I'm addressing bonds and their recent decline. And I've received a few questions from clients as to what's going on with their bonds and their bond funds. They want to know, why are bonds declining? What, if anything, should they be doing regarding this decline? And given this decline, should they still own bonds in their retirement portfolio? So in this episode, I'll be answering those questions as well as giving you some more understanding of how bonds work. If you haven't already done so and you're watching my YouTube channel, make sure that you click the subscribe button below. Or if you're listening on your favorite podcast app, make sure that you also subscribe or follow so you don't miss an episode. As a special thank you to anyone watching or listening, I'm giving away a free copy of my book called Fiduciary. In it, I help you to figure out how to find and hire the ideal fee-only financial advisor for you, explain what a true fiduciary financial advisor is, as well as give you many helpful suggestions when it comes to planning your retirement, setting up your investment portfolio, paying less in taxes, and managing your estate. To download a free copy, head over to retirewithryan.com, and on the homepage you will see click here to download. So before I discuss the recent decline in bonds, it's important to understand what a bond is. In case you're not familiar, a bond is a loan between you and the issuer of the bond. You agree to loan them your money, and they agree to pay you interest for that loan. You also agree to loan them the money for a certain time period, or otherwise known as a term. At the end of that time period, they agree to then pay you back your loan, usually in full. And there are four main types of issuers of bonds. We have government bonds issued by governments, corporate bonds issued by corporations, agency bonds issued by agencies. In the US, that would be institutions like Fannie Mae and Freddie Mac that are a vital part of our mortgage market. And finally, municipal bonds issued by municipalities, could be a town, could be a city, could be a state. There are also varying lengths of terms of bonds that you can purchase. The shortest term is the 4-week US Treasury bill that you could buy. And there are very long-term bonds, such as the 30-year US Treasury bond. Corporations also issue bonds and can issue bonds with up to 30-year maturities, and some can even go longer. There was recent talk about SpaceX that they would issue a 100-year bond, but they ultimately did not do that. Bonds are also rated by various rating agencies such as Standard & Poor's and Moody's. The highest rating is AAA, then it goes to AA, then single A, then triple B. Any bond rated triple B or higher is considered an investment-grade bond. This means that there is a low probability that the issuer will default on the bond. Bonds with a rating of less than triple B are considered junk bonds, or otherwise known as high-yield bonds. When you buy these bonds, you can receive more interest than an investment-grade bond, but you run a higher risk that there will be a default with this bond. A default is when the issuer doesn't pay their principal or their interest back to you on time. This triggers a legal process where investors may negotiate a restructuring, seize pledged collateral, receive partial cash, or even new securities through bankruptcy proceedings. You don't want to go through a default as an investor, as it can be a very stressful and long process. If you're investing in bonds for your retirement, you probably should invest mostly with investment-grade bonds for the majority of your portfolio so you don't experience defaults. Coming out of a recession, or if the economy is strong, you could potentially earn more by investing in high-yield or junk bonds, but as I said earlier, you're taking on some more risk to do so. When the economy begins to decline or we head into recession, you want to try to avoid owning high-yield or non-investment grade junk bonds, as these bonds will usually fluctuate more in price and can be more harder hit during these difficult times than investment-grade bonds. So now that you have some of the basic understanding of bonds, back to one of my original questions, why have the majority of bonds declined this year? Are we in a recession? The shorter answer is no. So what is causing this decline? Well, the price of bonds have what is known as an inverse relationship with interest rates. If interest rates go down, then the price of bonds actually go up. That's the inverse relationship. If interest rates actually go up, then the price of bonds will go down. The most common way that this change in interest rates is measured in the US is by looking at the yield on the 10-year US Treasury bond. This is a good barometer for the overall bond market. The yield on the 10-year US Treasury started the year at 4.15%. Currently, it's at 4.66%, and it was even a little higher a few days ago. This is a 0.5% increase in that rate. Now, that doesn't sound like much, but that is what is causing the price of bonds to decline, as well as causing the price of bond funds to decline. One of the most popular bonds in largest bond index ETFs is the Vanguard Total Stock Market ETF, symbol BND. This fund invests in treasuries, corporate bonds, mortgage-backed securities. It attempts to track the overall U.S. bond market. According to Morningstar.com, its total return is 0.20% on the year as of August 19, 2026. This is despite the fund having a yield of 4.13% to begin the year. That's the interest payment that you're receiving from the fund. That means that if the fund price didn't change at all over the year, you would earn 4.13% for the year. However, due to the decline in the value of the fund from interest rates going up, you haven't actually made much money in this fund for the year so far in 2026. Last year, this fund's total return was 7.08%. That was including the interest that the fund paid. However, last year, the 10-year U.S. Treasury started the year at 4.6%, but then declined to 4.15%. It's kind of the opposite of what's happened this year. So as I said earlier, when rates go down, bond prices go up. So that is a large part of the return for last year on this fund, BND. There are other funds that solely track the U.S. Treasury market. One fund is the State Street Spider Long-Term Treasury ETF, symbol SPTL. Its goal is to track the Bloomberg Long U.S. Treasury Index, which is treasuries that have a remaining 10 years or greater maturity. Because the maturity of this fund is longer than the Vanguard Total Bond Market ETF, this fund is even more sensitive to increases in interest rates. So it started the year with a yield of 4.10%. However, despite its yield, its total return for the year as of August 19, 2026 is a negative 3.30%. So why have interest rates moved up? Well, that's always a complicated question to answer. But from my research, it really is dependent upon three factors. The first being that bond investors feel, and the overall market does, that the Federal Reserve is signaling that they will increase interest rates to slow down inflation. Number two, when deficits swell and governments issue more debt, which our U.S. government recently passed the $40 trillion mark of total U.S. debt that's out there, and the U.S. is not alone. Other governments that are in a similar position, investors usually demand more for the risk that they're taking in buying long-term debt. And third, technology companies have recently issued a lot of debt to fund their investment in AI. AI, you might have heard the term hyperscaler, is going to take a tremendous investment. And to pay for this investment, a lot of these technology companies are issuing bonds. And because they're paying a higher rate, that also means that the treasury rates are going up as well. Just like the stock market, the bond market moves up, it moves down based on a lot of factors. It sounds simple, right? It's not. It's as complex as the stock market. So now that you know what is happening in bond prices and the reasons why, what should you be doing about it? As I see it, you have three options if you're already invested in bond funds, whether it be intermediate term funds like BND or longer term funds like SPTL. Or there's another fund just like SPTL you might be familiar with called TLT. The first option is that you can just do nothing. Option number two is that you could sell some of your intermediate to long-term bonds and you could go into shorter-term bonds. You could buy short-term treasury bonds. You could buy other short-term treasury bond funds like Bill or SGov, or you could even go into money market. Or option three, you could buy more intermediate to long-term U.S. bonds. So what should you do? Well, it's possible that interest rates go higher from here and you could experience even further losses in your bonds or bond funds. It's also possible that interest rates can actually go back down, and you can recover these losses in your bond funds. Trying to time the bond market based on changes in interest rates is as difficult, as I said earlier, as trying to time the top and the bottom of the stock market. If you're a long-term investor, then you probably should do nothing, assuming that you're in a well-diversified bond index fund or bond fund, because interest rates will most likely eventually come back down. If you don't own intermediate to long-term bonds and you're all in money market and have been for a while or in short-term CDs, then you could possibly buy some intermediate to long-term bonds or bond funds because you could earn more interest that you can currently in a money market or a short-term CD. And when the value of your bonds start to when interest rates start to go down, the value of your bonds can go up. However, if you do this, the value of your investment will fluctuate more than a money market or a short-term CD because, as we just been discussing, the price of bond funds is going to fluctuate based on changes in interest rates. If you're risk averse, then you may just want to stay in money market or short-term CDs, but realize by doing so, eventually, you're going to have a lesser return than you could achieve by owning intermediate to longer-term bonds. Eventually, you'll want to invest in these over time to increase the return in your portfolio. Lastly, should you still own bonds in your retirement portfolio, given that bonds are down on the year and could further decline if interest rates continue to increase? The quick answer is yes. If you're a long-term investor, as most retirees are who are going to be investing over 20, 30-year plus retirement time horizon, then you do want to own bonds. Bond prices have always fluctuated in the past. They will continue to do so in the future as interest rates change, as things in the economy change. However, even with the recent fluctuations and declines, there's always going to be less fluctuation in the price of intermediate to long-term bonds than there is when major declines occur in the US stock market and even international markets. They are a much safer investment than stocks because they do have, if you're dealing with investment grade, they do have certain covenants and requirements to pay you back interest on time. So as a retiree or pre-retiree, you don't want to have all of your money in the stock market. No matter how optimistic you are about your favorite stock or your favorite stock index fund, you don't want to be forced to sell stocks or stock funds when stocks market declines if you need income for your portfolio in retirement. Additionally, by having some money in bonds is also going to lessen the volatility in your portfolio. And having money in bonds gives you a bucket or a portion of your portfolio that you can now draw from for income in retirement when the overall stock market might be down. So overall, the media never lets a good crisis go to waste, but this is another one that you really can ignore and get back to more important things and enjoy the rest of your summer. Hope that you enjoyed this episode and found it helpful. As always, if you have a listener question you want to have considered for a future episode, head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking with you next Tuesday. Take care.